In the next 20 years, over 1 billion people are going to enter the formal financial sector, taking out loans, opening savings account, or sending payments for the very first time. The module in my course examines how firms can profitably provide these financial services to these new customers in a way that improves customer welfare. The module covers the gamut of financial services products, from savings to credit to insurance and payments, in a variety of settings: Africa, South Asia, and Latin America. While there are technical skills and tools that we develop, we emphasize 3 key lessons in the module. The first is understanding the customer. Of course, this sounds obvious, but in the context of financial services, it's particularly important. All people, including the poor, have behavioral biases, such as not quite understanding how compound interest works. This can work in interesting ways to both stimulate or suppress demand for financial services. Understanding how people respond to risk and vulnerability can dramatically change the apparent attractiveness of products that a company might design. The second key lesson focuses on reducing and efficiently allocating transaction costs. Let me give you an example. In the US or Europe, to open a bank account, you'd head into the bank, fill out some paperwork, and you'd have your bank account open. You might stop by the branch from time to time to make a withdrawal or deposit or apply for a loan. But in general, you wouldn't have much contact with your bankers. In contrast, in developing countries, microfinance has taken off by flipping this relationship around. The banker gets on a motorcycle and heads out into the village to meet weekly with borrowers. At first, this sounds a little bit crazy. How could it make sense for a small dollar loan, such as a $100 or $200 loan, for the bank to send somebody out to the customer? But when you realize that the loan officer can service 20 or 30 borrowers at the same time and travel much more efficiently than the borrowers can, who don't have a motorcycle and might have to spend 3 or 4 hours moving on public transportation to get to the bank branch, this makes perfect sense. Financial service firms can also take advantage of local knowledge and reallocate these transaction costs to the customers. For example, in microfinance, borrowers are often asked to vouch for other borrowers, which allows the banking providers to use local knowledge in evaluating the credit risk of borrowers. The third theme of the course is managing external risks. The base of the pyramid populations represent the majority of the population in most emerging markets and are therefore politically quite important. For thousands of years, financial services providers have been accused of exploiting or expropriating the poor by charging usurious interest rates or offering products or services that the poor don't understand. In addition, many governments have themselves gotten involved in providing financial services to the poor, for example, via subsidized loans or savings schemes. When conducting business in such environments, it's very important to understand the context and the potential challenges of expropriation and political attack. While the primary focus of each case is how to succeed in running a business in these areas, the 2 additional themes underline the module. The first relates to evidence of social impact. Many of these businesses are founded first as nonprofits and subsequently convert to for-profit entities, or are founded as for-profits but with the goal of promoting the welfare of the customers. However, it can be difficult to know how and how much a product is actually helping the customer. Throughout the modules, we discuss the evidence on the effects of savings, credit, and insurance on consumer welfare and well-being. A second theme of the course is impact investing. In some sense, microfinance is the poster child of success for impact investing. Over the past 20 years, we've seen dozens of private equity transactions, several IPOs, and billions of dollars of wealth created through the success of financial service firms serving the poor. Through this lens, we examine the motives and challenges facing investors, operators, and regulators in this environment.